Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the ETF.com conference, and I'm here with Dodd Kittsley, head of ETF research at Deutsche Asset and Wealth Management. Dodd, great seeing you.
Great to be here again, Tom.
Yeah, it's a great conference. There's a lot of conversation, though, about foreign currency, and there's a lot been going on, so kind of give us a lay of the land.
If there was a lesson to be learned in 2014 from an investment perspective, it was the dramatic impact that currency has, not just on returns, but on the risk of an international equity investment. And now, investors finally have a diverse toolbox in which to be able to control for that risk, eliminate it, and be able to invest more precisely in international equity markets.
You know what's interesting, when we did our virtual summit last week, we did a survey, and advisors, number one, were most concerned about Fed rate hikes and how that affected fixed income portfolio. Second, they were concerned about an equity correction here in the US after a 5-year bull market. But very few were concerned about currency risk, but that's something that we should put the headlights on, right?
We absolutely should, because what we saw in 2014 were respectable returns in developed markets, in emerging markets, in Japan, in Europe, that were obliterated and actually converted into losses due to the strength of the US dollar exclusively.
Right, so let's cut this down and make it really simple. There are two headwinds going. There's Fed hiking rates, which is going to appreciate the dollar, right?
Yes.
And then we've already seen what Japan and what the ECB now is doing as far as increasing monetary policy, lower currency, so they're both working against each other, right?
Right.
And that all affects your global equity positions, right?
Absolutely, it's a classic case of divergence. What's happening in the US is completely different to what's happening in Europe and in Japan. And it's driven by central bank activities, you suggest. And moreover, what the central banks have done has lasting effects over very, very long periods of time. So many advisors have come to us and said, wow, 2014 certainly was a year where there was dollar strength. Did I miss it? And the answer is no. Historically, these trends last 8 years and longer, and we're only in the second to third year of US dollar strength.
Yeah, maybe not even. Like you point out, some of these trends, if they go a very, very long period of time, I mean, for the euro, for example, we could see parity before we know it.
Absolutely. We're forecasting, actually, that the dollar-euro will go down to 90 cents by the end of 2017. So that's still a pretty material move over current levels and a meaningful headwind to return for those that are unhedged.
Is that when you and I start buying more French wine and cheese?
Absolutely. We're going to have to make our trip over to Paris or something.
So early on, Deutsche Bank Asset and Wealth Management designed a whole suite of currency hedge ETFs that not only handle certain global regions, but also specific countries.
Absolutely. We decided in getting a complete toolbox based on MSCI indices that are broad-based, starting with individual countries like Japan, like Germany, even South Korea, which is actually an interesting story in and of itself, but then going up into regions like the Eurozone, like Europe in general, then even going higher, emerging markets, developed. And for folks that want to keep it incredibly simple and think about international equities in terms of a core holding, the MSCI All Country World ex-US can be accessed through DBAW.
DBAW is a ticker, and it's an all-inclusive global coverage.
Developed, right? Emerging, it is the quintessential core holding minus the currency effect.
Okay, so finally, as a portfolio allocation, how do you just go currency neutral?
Currency neutral really is a 100% hedged position. Because what hedging does is essentially neutralizes the impact of currency, and it takes it out of the equation entirely.
So if out of my equity position, if I'm 25% global in the portfolio, what would I do?
You could go your full 25% in terms of a hedged position. Now, some investors may not want to do that, or they might have existing holdings already, so that what they can do is sprinkle in some of the hedge to be able to mitigate the impact that currency has. But make no mistake about it, if you own an international equity investment and the dollar strengthens, that's taking money out of your pocket, and it's a missed opportunity.
Right. Dodd, as always, thank you very much.
Thank you.
Great seeing you.
Enjoyed it.